If you've been following along with my last few videos, you'll know that we're building a database of trading strategies together here on YouTube. Each week I take a trading strategy, I program it, and then I backtest it using 14 different Forex pairs, and I backtest it using over 15 years worth of data. I explain the strategy rules in full, so if there's a strategy which you like the look of, then you can copy along and use it for yourself, and then I'll show you all the results. Once I have the results, then I put them into the strategy database, and I'm giving you full access to that strategy database for free. So that way you'll know what strategies work on which markets and which ones to avoid. Let me just remind you that all the strategies which I'm going to be showing you, and all the ones that I test, are 100% rule-based or algorithmic, meaning there's no room for discretion or perhaps cheating the backtest. I mean, sometimes it's unknowingly cheating the backtest. Unfortunately, I do see a lot of people testing out strategies where a little bit of discretion is required, but what that means is their test results can be wildly different to yours. If you copy the rules to the strategies which I present to you, which are 100% rule-based, then your results should be very similar to mine. There's always going to be slight variations because we're dealing with the Forex markets, and Forex data from one broker can be very slightly different to Forex data from another broker. But those minor differences are fairly insignificant. The strategy which we're testing out today is the same strategy which I tested out a few weeks back. However, today I'm using the same entry rules, but I'm using a different exit. We're using an opening range breakout as a trigger to get in the trade after a narrow range setup on the daily charts, and the exit is simply a stop loss or a profit target. Or sometimes if we haven't exited for profit or the stop loss, we might get an entry to enter a trade in the opposite direction, so that's an additional exit. The profit target which we're going to test out is simply a multiple of the stop loss value. I'll show you how to calculate the size of the stop loss, and then we're going to test out different multiples for the profit target, such as 2 or 2 times the stop loss value. And we're going to test out 3 different profit targets across 14 different Forex pairs. Personally, I'd like to see all 3 of those profit targets working on any one of the markets before I considered trading it. Now, just let me remind you of the entry conditions, and then we'll go and have a look at all the backtest results. Firstly, we're going to look for the trade setup, and we're going to be looking at the daily bars, and I'm going to use average true range, and I'm going to use a length of 2 for the average true range. So we're looking at the average true range over the past 2 daily bars, and we want to see that the average true range on the close of this daily bar is the lowest over the last 20 days. So our range is contracting, it's narrowing, and that's where the name for the strategy, narrow range, comes from. Once we've got the trade set up, then we can look to place orders the next day, and that brings us on to the trade entries. Now the first thing we want to do is calculate the average noise over the last 10 days. Now the noise is calculated either by looking at the open minus the low, or the high minus the open, whichever's the smallest. And we calculate that for each of the last 10 days, add them all up, divide them by 10, and that's going to give us the average. Once we have that, we move on to number 2, which is we multiply that number by a fixed multiple, and we're going to use 2. And that's what is called the stretch. Once we have that stretch value, then we move on to number 3, and we place a buy stop order looking at the open of the day plus that stretch value. So we want to know if the market moves upwards and it hits a certain value, which is calculated by that open plus the stretch, then we're going to get in the trade. And it's the same for a short sell. We look at the open and we subtract the stretch from the open, and that's our sell short order, and they're going to be stop orders. Rule number 4 is we're only going to take 1 trade per day. So if we get long into a trade, then we're not going to enter a short trade that day. The stop loss is the opposite order. So let's say we did get long that day, then our stop loss becomes that sell short order, which was obviously the open minus the stretch. So if you imagine we have the open and then we have a value, let's say it's 30 pips above the open, which might be the buy price, and a value 30 pips below the open, which might be the sell short price. If we get into a long trade, then we cancel the order to go short on that 30 pips below, but then that becomes our stop loss. So that's the entries, which are the same as when I tested this strategy previously, but we've got a different exit now. So number 1, first exit is that stop loss. And going with that example I've just mentioned of the 30 pips, so if our order was 30 pips above the open and our stop loss was 30 pips below the open, then the size of our stop loss is going to be 60 pips. So we know where to place the stop loss and we know how big the stop loss is going to be. Number 2 is stop and reverse, and this only happens after the first day because we only take one trade the first day. And that means if we haven't hit our stop loss or we haven't hit our profit, but we get an entry signal to go in the opposite direction to what we're already in, then we exit the position we're already in and then open the trade into the new position. And then number 3, this is the profit target which we're going to be testing out in this video, and that's a multiple of the stop loss value. In the example we mentioned the stop loss value was 60 pips, so if we had a multiple of 1 times the risk or 1 times the stop loss value, then our profit target is 60 pips. And I've just put a little note there that I believe that a robust strategy on any market should show positive results on all of the profit targets which we're testing. I've chosen to test the reward to risk ratios of 1-to-1, 2-to-1 and 4-to-1. But obviously I could have tested lower than that and I could have tested higher or anywhere in between. But I've chosen those values just because most people are going to be comfortable with those sort of profit targets. And I started at 1-to-1 and just doubled it every time. So 2-to-1 and then 4-to-1. And any market which shows consistent profitability on each one of those 3 reward to risk ratios will most likely show profit on any of the values in between those anyway. So if we've got all 3 profitable and you want to use a reward to risk ratio of 1.5-to-1, then it's most likely is going to be profitable anyway. Okay, so let's go and have a look at the results. The first test we're going to do is using a 1-to-1 reward to risk ratio. All the testing is using Oanda's data, and we got data from January the 1st, 2008 through to the 19th of January 2023. And down here you can see all the Forex pairs which we're testing. So let's have a look at the back test. So here's the results of the complete portfolio over the 14 pairs. Now these results are going to be in pips. It was overall profitable over the 14 pairs combined. That's what the equity curve looks like. However, I suspect that looking at the average trade value of 0.71 pips per trade, that's not going to be profitable once we've added in costs such as slippage, commissions, overnight costs. So really we're going to look at individual pairs which this strategy is going to work on. And we can do that by looking here, going through them here. Now somebody requested in one of the last videos to keep the video shorter. Maybe I shouldn't bother showing you the report of the negative performing pairs, or maybe just show the worst performing pair. So looking down these, we've got Australian dollar, US dollar is not profitable, Canadian dollar, yen not profitable, euro pound not profitable, euro yen is profitable. So let's have a look at that. That's what the equity curve looks like. And looking at the average trade value, we've got an average trade of almost 17 pips per trade. So that's good. By the time we've taken a few pips out of that for costs, then it's still going to be a money-making strategy. It's profitable about 55% of the time. Euro New Zealand is just profitable, but the average trade value is only 2.78 pips. That's not going to be profitable after costs. Euro dollar, average trade value, 4.7 pips. That's pretty small. If you were trading with very tight pips, then maybe you'd get some profit out of that. But that's what the equity curve looks like. Obviously had a terrible time early on, then a really good time, and then it's essentially just gone flat. Probably not something you'd want to trade. Pound Canadian dollar, not profitable. Pound yen is the most profitable, so let's have a look at that. There's the equity curve. That's quite nice, isn't it? Quite a nice uptrending smooth curve. But is the average trade big enough? At 27 pips, yes, it certainly is. That's a really good average trade. So pound yen, this seems to work quite well on. Pound dollar is the largest losing pair, so let's have a look at that. We know we're going to have negative average trade value. And that's what the equity curve looks like. So this strategy definitely doesn't work on pound dollar. New Zealand dollar, Canadian dollar is negative. New Zealand dollar, US dollar is positive. There's the equity curve. I suspect the average trade value is small. It is small at only 2.5 pips. US dollar, Canadian dollar, negative. US dollar, Swiss franc is positive. Average trade value again is a little bit small, only 5 pips. Equity curve is not that great. And lastly, we've got US dollar, Japanese yen. It is profitable. There's the equity curve, not that great. And the average trade is only 4.3 pips, so that's not very good either. So really, using the one-to-one reward to risk ratio, clearly the best one to be trading is pound yen. And the worst one, if you want to think about some sort of opposite rules, maybe look at pound dollar. Now let's look at the reward to risk ratio of 2-to-1, see if we can improve things. So you'll notice now that I've changed the input for the profit multiple. So now we've got a 2-to-1 reward to risk ratio. Let's see what the performance report looks like. Now this is the portfolio performance using all the 14 pairs. It's profitable. Equity curve is similar to before. But the average trade is higher, but still not high enough to consider trading all of those pairs in a portfolio. Let's look at them individually. Looking at the profitable ones, Canadian dollar, Japanese yen, average trade of 8.8 pips. Equity curve is not very good. The next profitable one, euro yen. Equity curve not very good, extremely flat right up until the most recent years. Euro, New Zealand dollar. Equity curves okay. What's the average trade value like? Oh, we've got a big average trade value of almost 24 pips, so that's possibly something we could trade. And then we've got negative, negative. Pound yen is the most profitable again. Got a huge average trade of 40 pips. And another reasonable equity curve. Pound dollar is the least profitable again, with a similar equity curve. New Zealand dollar is barely making any profit. Dollar Swiss franc, barely making any profit. Dollar Japanese yen is making profit. Probably a better equity curve than before, but not that great, is it? Average trade value, a usable 9.4 pips. Well, that's 2 out of the 3 profit targets tested. And we found some individual markets which the strategy works on. The standout forex pair being pound yen. We'll see how that responds to the 4-to-1 reward to risk ratio next, but I suspect it's going to be profitable. If you don't like the idea of trading opening range breakouts and you're looking for more strategy ideas, then you can get my 22-page Beat the Market Strategy Guidebook for free at the moment. In the guidebook, I'll give you 3 more strategies, I'll give you all the rules, and I'll show you the backtest reports. If you're interested in that, like I said, it's free, and I'll leave the links to that so that you can download that immediately. Links in the description down below. But better still, you can enroll in my popular trading course. In the course, I'll show you how to trade those strategies. I'll show you how to use correct position sizing to maximize your results and minimize your drawdowns. And in the course, I'll give you 6 more rule-based strategies. And for those of you who like to use trading software like I do, I'll give you the code so that if you're using TradeStation or you're using MultiCharts like I do, you can download the code and use it in your software. If you're interested in that, then the links will also be down below. And the last profit target that we're looking at is a 4-to-1 reward to risk ratio. So let's see what the results are like for that. This is the complete portfolio of 14 forex pairs, 7,400 pips. That's more than the others. The average trade is the highest yet at 3.12, but still not usable. And the equity curve isn't very good. Let's have a look at the individual forex pairs. Just looking at the positive ones, euro yen. We've got a usable average trade of 11.85 pips. but the equity curve is not particularly desirable. Euro, New Zealand dollar is profitable, but not by a lot. Euro dollar, not by a lot. Same story, pound yen is by far the most profitable pair, so let's have a look at that. Again, definitely an uptrending, fairly uniform equity curve, so that's good. And the highest average trade yet of this pair at 52 pips, that's very good. The biggest loser is the same again, pound dollar, and another terrible equity curve. New Zealand dollar, US dollar makes a little bit of money, not a lot. Dollar Swiss franc makes a little bit of money, not a lot. And dollar yen, let's have a look at that. And that's probably the best dollar yen equity curve so far, with an average trade value of 20 pips, so that's pretty large, that's good. So using the 4:1 reward to risk ratio, I would only be looking harder at pound yen or dollar yen. So that's what the results look like from that opening range breakout strategy from a narrow range setup using just a profit target. Clearly, this strategy works best on pound yen. And remember, I've also done another test using the same entry setup but a different exit. I used a timed exit where I exited after 3, 6 and 12 days in the trade. Timed exits aren't particularly popular, and that's probably one of the reasons I actually like using them. So if I had the choice about using the timed exit or the profit target, then I would probably choose the timed exit for this strategy. But let me know which one you prefer and for what reason. I'll add all the results from today's tests into the strategy database, and I'll leave the links for that down below so that you can access that whenever you like for free. By the way, I've had a load of feedback on that strategy database already from you guys, so that's been really helpful, and I say thank you for that. Most of the feedback has been positive, and there's been some really great suggestions on how to improve it. I'm just trying to make it as useful as possible for you guys. Well, that's all for today's video, but hopefully I'll see you next week for another strategy to test out. But until then, this is Jared Goodwin, and thank you.